The stock market took a big hit from the health crisis with the shutdown of parts of the U.S. and global economy. The major indexes are off more than 20%. Our Bill Fitzgerald sat down with an expert to find out what it means for your retirement investments.
I'm joined now by Sandy Wiggins from the Actuarial Consulting Group in Midlothian. Sandy, thanks for joining me today. We've been talking so much about the market volatility. It has been a tough climate for investors and really, obviously, workers themselves. High unemployment, the market down about 20–25%, even with some of those good days we've been having. What's going on out there?
Well, yeah, there's a lot going on, and it all comes down to the volatility, the concern around the coronavirus, and the impact on the economy. What we can do is quickly look at a graph that lays out from the beginning of the year through the end of March, and there's a lot of information on the graph, but as you can see, the blue line really represents what we've seen as investors. It's the MSCI World Index, and it really lost about 10,000 points in a very, very short amount of time.
Yeah, I mean, as recently as early February, we're kind of back in those high rolling days. You've talked so much about fear and how not to let emotions guide any of your investment decisions. You always say, stick to your allocation, whatever the blip is, whatever's going on in the economy. Just stick to your guns. Fear, obviously, as I can see here, can cost you.
Yeah, if we think about the emotional side of anything, when we get scared, you want to stop the fear, you want to stop the concern. And in the markets that we've seen over the last month, the emotional decision is, let me get out of the risky assets, in this case stocks, and move to something that's safer. But as the graph shows, the average investor usually gets the timing wrong, and so selling when you're fearful is really not a recipe for success.
And you can really show that the returns are simply better if you stick to your regular investment, the way you're investing. Do that regularly, because after a down market, seems to be the time to get in.
Yeah, if we go back in time, the average of the S&P 500 is about 9% a year. And as you see on this particular graph, there's a lot of information. But if we look to the right, you'll see the orange column of 14.1%. This historically is the return, again, on average, that we benefit from after a rebound in the market. And we're already beginning to see some rebound in the market. 14.1% is above average. We're coming off of market lows. The yellow represents the 3-year average return from a bottoming of a bear market like we're seeing of 12.2%. So selling at the bottom, you give up these nice rebounds. And it may take some time for that to happen, but certainly you want to be in the market when it does.
And yet, who should be nervous in this environment? We're all nervous. People are losing their jobs. Obviously, anybody looking at their investments is kind of horrified. If I'm retiring in the next year or two, I mean, I should obviously be nervous, right?
Yeah, I think anybody that's in the market in this environment has a reason to be nervous. But if you're someone retiring in the next year or two, hopefully you've already positioned your portfolio to be more conservative. You've added bonds to the portfolio and you've reduced the stocks. By doing that, you would avoid substantial down drafts like we're seeing. Now, if you haven't done that, the last thing you want to do is sell now and reposition. You want to make sure that you let things rebound a little bit, and when things calm down, make some good decisions about positioning your portfolio to be more conservative for your.
All right, good stuff. Sandy Wiggins, Actuarial Consulting Group in Midlothian. Thank you, sir.
Thank you, Bill. Take care.
Well, tonight we're going to see those temperatures